Welcome, everybody, to another edition of Amplify Your Business. Today, I'm going to be talking to Kristina Milke. She is a founding partner of Sprout.vc. They are focused on investing in Western Canadian companies. And, well, Kristina, why don't you just tell the rest of the story, I guess, around what it is that you guys do over there at Sprout.vc.
Thank you. Thanks for having me. So Sprout.vc is a venture capital fund that invests in early stage or seed stage technology companies, B2B SaaS specifically, and anywhere from Manitoba to BC.
Okay, now that is really quite specific. And so is there a reason why you guys chose that style of business to invest in?
There is a few reasons, actually. So one is, we are the managing partners of this fund. We're not experts in med tech or agricultural or life sciences stuff. So it's kind of a process of elimination, right? You take out the things that you don't have expertise in. And we love companies that have a global market opportunity and that can scale quickly and are asset light. So those are the kinds of companies that we feel we'll have the best opportunity to get them to a point where they can scale, and we see an exit opportunity for the fund.
Yeah, and that's what it's all about, right? You have to have that big, hopefully really big exit as an investment company like what you guys are doing.
For sure. We have fund metrics that we have committed to our investors. So our goal is to hit those fund metrics or beat them. Yep.
Okay, so before we get into what it is that you do in terms of the mechanics of the venture capital investment side of it, why don't we hear a little bit about your backstory and how you got to where you're at today? So earlier we were talking, you were a grad from the University of Alberta, just like myself, and then you had a really interesting career. So would you mind walking us through that?
Sure. So the only thing I ever knew was that when I went to university into the business faculty was that I thought I might become a CA, a chartered accountant. And so I focused on getting a job in a public accounting firm so that I could get my hours and get that designation. I articled at Ernst & Young. I left there when I got my letters and went to a client that was in the oil and gas space. I realized within a year that really wasn't a sector that I was that interested in staying in. So I left and I worked for an aerospace company. And what was really interesting about an aerospace company, one, it was a publicly traded Canadian company, but also that we worked on very large contracts with different foreign militaries. So I got really exposed to large proposals that would have to go out and working with organizations that were outside of Canada. So it was a really great exposure to international and foreign currency things that are kind of fun for accountants like me. And so I left there after about 6.5 years, and I decided to go and work for a company called Intuit Canada, which likely people would know it from TurboTax or QuickBooks. And so I ran their finance team here in Edmonton. At the time, it was also global. Their global division's now completely different and much broader, of course. And so I was there for 3 years approximately. And then I left there and decided that I really didn't want to run a finance team anymore because I've done that. So I really wanted to, own the P&L. I wanted to be responsible for the end-to-end part of the business. And so that's when I got brought into an organization called Investopedia, which is a great startup story out of Edmonton. Yeah. At the time, the company was owned by Forbes. The original founders were still in the organization, but were exiting. And once they left, about 18 months into my tenure, Forbes decided that they wanted to sell the business. And so I got tapped on the shoulder, and part of my job became to help pitch it to the prospective buyers. So I spent a good chunk of that summer in New York, working in a fancy boardroom in Midtown Manhattan, pitching the company to companies like AOL, MSN, some private equity groups, and the ultimate buyer that was a company based out of LA, publicly traded company out of LA. But while I was there, I started to get investing. I started my investing career. So I joined an angel group, which was something that was quite fascinating. I got brought to a meeting, and I had never heard of this before, but it was very much like a Dragon's Den sort of experience, except everybody there is really just there to support the entrepreneurs. Sometimes I see on Dragon's Den, there's some sensationalism that happens, and that is not exactly at all what I experienced in the angel group. So people would come up and pitch. There'd be 4 companies, and there would be a setup of tables, and people, all the different investors or interested people around, and the company would pitch, and then we'd get to ask some questions, and there'd be 4 companies over the evening. And then if you were interested to have further conversations with the companies, you would sign up on a sheet, and you could go through your own due diligence. So it was very much doing your own due diligence, making your own investment decision, and investing directly with the company. And so that's when I got really excited about this whole space around angel investing and startups. And having experienced the actual pitching when we were pitching Investopedia for sale, I really started to empathize with those founders that had to get up there and pitch in front of all these people. It's quite nerve-wracking, and being able to answer questions on the spot. And so when I actually left Investopedia, the founder of this angel group, I spoke with that founder and said, I'd really love to help on the front end, the intake side, when you bring the deals in. And I really started to get to meet so many interesting entrepreneurs. Not all of them obviously would get into the group, but I was the one that got to talk to them, go through them, see if they would be a good fit for the angel group, if they would have a high probability of potentially raising capital. We never wanted to waste anybody's time. And then after a couple of years of that, myself and the founder of the angel group and a few other people put together an organization called Valhalla Private Capital. The angel group got rolled in. And so we had a few different divisions in Valhalla Private Capital. I was the president of the angel group, and we expanded the angel group from being, originally having 2 chapters, one in Edmonton and one in Calgary. We expanded into BC. So we had a chapter in Kelowna. We expanded into Vancouver. And as I was leaving, we managed to negotiate a deal so that we could get access into Saskatchewan as well. So we tripled the footprint in the time that I was there, which was really exciting. And I met so many entrepreneurs, and I started doing a lot more mentoring. But I also met some really awesome folks who were also members of Valhalla and investing themselves as angel investors. And we got together and decided that we wanted to start a fund. And so we ran our first pilot fund, so Sprout version, Fund 1, basically. And it was a smaller fund. There was 4 partners, and we didn't quite have our investment thesis worked out. We didn't exactly know what we were doing, but we knew that this pilot fund would, 1, make sure that we could all work together. 2, would help us refine our investment thesis, learn how to fund manage appropriately. And the other big goal was to try and get investors into the fund who had never invested in the tech space before, because we know that there's money here, but a lot of that money goes into, traditional investment vehicles like real estate, oil and gas, the public markets, right? And so our goal was to try and get in investors in who had never invested in this space. And our commitment to them was, look, every time we make an investment, we're going to share that with you, why the company and why we picked them. And we do great updates with them every quarter so they could get a good sense of how those companies are progressing. And that's what we did. And so Fund 1 got fully deployed in 2021. And then we started raising our second fund, which is considerably bigger. And we're just closing now our first close in our second fund.
Very exciting stuff. And so I'm just curious, because the first fund being in 2021, we're in the middle of the pandemic. When you're trying to raise money for that, was that more difficult, less difficult? What would you say?
It's a good question. So the second fund we started raising in 2021. The first fund we raised and we started deploying capital in 2019. So we finished the last investment in 2021 in Fund 1. We were still finishing off Fund 1, and we already started raising for Fund 2. And yes, it's been challenging. And I have to say, it's really hard to build connections with people you haven't met. So we have, about half of our investors from Fund 1 have come into Fund 2, which is awesome. They trust us. They want to come along for the next journey with us, and we're really excited to have them. And then a lot of the other investors were based on personal connections, people that we knew that have, had heard about our first fund and trust us. And then there's, some folks that we were referrals. We didn't have a relationship with to start with, and building that relationship over Zoom or whatever platform you want to do it on is a little bit more challenging, because, no different than this meeting between you and I right now, we're not getting the opportunity to have a little chit chat, to get to know each other, to learn a little bit more personally about each other. You're doing all this on a Zoom and trying to get them to agree to invest quite a large sum of money with you for the next 10 years.
Yeah. Like anything, right? People buy from, and I'd imagine invest with, people who they know, like, and trust. And so,
that's right.
Yeah, it's the people, it's the relationship that matters.
For sure. Some of the new investors that I didn't know, I have to say, some of them, we've become quite friendly now, and we're texting each other on other things besides the fund, which is kind of nice. So I have made new friends out of it as well.
Yeah. So how many investors do you typically have then in a fund?
In our first fund, we had 48 investors, and the buy-in was quite small because it was a small fund. Our second fund, I haven't looked at the tally yet, but I'm guessing it's going to be probably going to be somewhere between 50 and 70, but I'm sorry, I don't know the number off the top of my head yet.
Yeah, no, that's quite all right. Just in case anybody is curious, what kind of investment level does it take to get into one of these funds then?
Yeah, so you have to be an accredited investor. That's number one of most importance. You can't come in unless you're accredited, because that's just the rules. And then the buy-in is minimum $100,000 over the 10 years, but we don't want all your money up front because we can't spend it fast enough. And when you're doing ROI calculations, that calculation starts the minute you have the money in your bank account. So we're doing it over 5 cash calls, so 20% each time. So the first 20% comes when we do the close, which is happening right now, and then annually thereafter for the next 4 years.
Gotcha. And for those people who don't or haven't heard the term accredited investor, can you just give a quick definition as to what you mean?
Yeah, I mean, I'm not, so the best way to find out the exact definition is to Google it online, but it has to do with a personal net worth or assets, financial assets that you own. So there's a threshold, and the reason that is there, the Securities Commission insists on it, is to ensure that, I guess they presume that people that have money are smart enough to understand making these types of investments. That's their definition and their requirement.
Yeah, comes with a certain level of risk that
exactly. So if you lose your money, you're not going to lose everything, basically, right? So yeah. I think that's kind of the thinking behind it.
Yeah. Now, your journey to this point has been filled with all sorts of really great opportunities, some really impressive positions that you've held along the way. Would you say that that's fairly typical then for people who are, in the business that you are running a venture capital firm?
I don't know what's typical. I mean, I can tell you that my partners have had a different journey than me in their careers. A few other folks that I know that are partners in firms have had, again, very different journeys as well. I don't think there's a typical, actually. I mean, there's some, of course, that, graduate out of, getting their MBA or their commerce degree, and they specialize in finance, and they start working for an investment firm, and that's their path, right? And they know that's what they want to do. But I just have never really had a fixed endpoint for me. My whole career, the only thing I knew for sure was I wanted to be a CA or a CPA. And beyond that, I didn't really have a path in mind. And so I was always very open to things when they came my way. And sometimes, like even going to Investopedia, I mean, that was not something that I had this idea that I was going to do that. It just, the opportunity came up. I knew in my mind I maybe didn't want to run a finance team, but I didn't exactly know what exactly I would do after that. And so when the opportunity came to me, or came towards me, even then it wasn't really defined. And I, myself and the gentleman at Investopedia at the time that I was talking with, we had to define what that role would look like. And that, they felt I would be a good fit in the organization, but what exactly I was going to do was not defined yet. And so I helped them come up with that definition to some extent. Yeah. And that I kind of like that, because when you're too fixated on having a goal at the end, you sometimes are closed off to other opportunities. So one might come right in front of you, you don't even see it because you're too fixated on getting somewhere else. Yeah,
that's a great lesson. And that's something that I echo as well. My career path, I never really had this really strong end goal in mind. I had a desire to follow my passion and my interest, and everything else kind of fell into place, or at least it fell into place to get me to where I'm at right now, because there was no other goals in mind.
Yeah. And as far as passion goes, I mean, I don't even know that I knew what my passion was when I was younger. I was just in pursuit of it, I guess. Yeah. And what I do know is that when I started getting involved with angel investing, I just remember getting so excited about the companies. I remember my first meeting coming home, my partner at home says, what was this meeting that you went to? And I think I went on for like 45 minutes to an hour before he finally stopped me and said, I was just hoping for just a quick 1 or 2 minutes, and you've been going on for 45 minutes. And all I remember saying this to him is, I don't know how or when or where, but something about this evening is going to change the direction of my career.
Yeah.
I knew it. Like, I just knew it in my heart, in my gut. And I just didn't know how it was going to play out.
So what is that? What is the piece that energizes you
Yeah,
about this? Is it about
it's so
helping
easy.
those businesses?
No.
No?
It's more simple than that. Even it's,
Oh,
a lot of the founders are young, ambitious, tenacious, and they have a vision to change the world. They truly believe that about what they're doing, and it's infectious. When you meet with them, it's hard to walk away and not be as excited as they are about what they're doing. Honestly, it helps me feel like that these people are going to make a difference in the world of the future, in my kids' worlds, and that, how important is that? Those kinds of visionaries are so critical to moving our local, our provincial, our country's vision forward. And so it's just hard not to want to hang out with them.
Yeah, I can relate, because so in our business, where we're helping businesses with their marketing and exposure and lead generation, customer acquisition, all of that kind of stuff, we do have a lot of startups and pre-startups that approach us, and some of them we have an opportunity to work with, some others we don't. But every one of their stories that they share with me, I honestly think I'd be probably the worst venture capitalist in the world, because I just want to push all my money into every one of them, because it's like, I believe you.
Well, you're like a kid in the candy store then. That's what I would call you. So that's how I was when I first started angel investing. And let me tell you, I put my money like with that in mind, like, oh, this seems really fun and interesting. And then I lost some money.
Yeah.
What you do when you first start angel investing. And then once you lose a little bit of money, you start thinking, okay, I must not be doing this quite right. There's got to be a better outcome. I mean, I'm still enjoying the ride, but it's not really fun losing all your money, multiple times, right? So over the years, you start thinking about, how do I get a little bit more methodical about making my decisions, and what kind of process can I put behind it? And then by the time you get into a fund and you're responsible for other people's money, which my partners and I take very, very seriously, like we want to be good stewards of that money, then you put quite a bit more process behind you and structure in place to make those decisions.
Well, this is a great transition into my next question, which is really around how is it you decide which companies, which businesses, which entrepreneurs to invest in, and which ones to, basically suggest that they need a little bit more work before they come back, kind of thing.
Yeah, that's a good question. So there's a little bit of science and there's a lot of art with this, especially in the early stages of these companies, because they don't have a lot of history behind them. You can't do valuation assessments based on traditional methodologies, for example, because they're too early. And sometimes the best you're going to get is being able to do comparables for other similar types of businesses, if you can find data on what their current valuations are. A lot of it is on sort of what the market pressure is around early stage valuations as well, right? And so the other things, though, that become really important are the terms of the deal. And so if you're the lead investor, you get to sometimes help set those terms. But in an early stage company, you may or may not be. You might just be an investor that's tagging along, and the terms are set. But some things that there's specific terms that we consider more important than others, and deal structures that are more important, or ones that we like better. Let's just say that. So that's one of the criteria. Another one would be the founding team. You're really making a bet on the founding team, and so. One of the things there's a couple things that we consider. So one is the diversity of the founding team. We strongly believe in diversity at the founding team level, or the C-suite level of the company. Not all of them are co-founders. Potentially they're just in a very critical role. We on my fund are also a diverse set of founding partners. We find, there's data that supports better outcomes from diversity. We like and think it's so important that we tracked it in our first fund, and 80% of the companies that we invested in have diversity at the founding or C-suite level. And we'll do the same in our second fund. We just strongly, strongly believe in it. We care about the coachability of the companies. We want founders that are, they have some good hustle. They need to be able to not be risk averse, obviously. You think they wouldn't be because they're doing this in the first place, but sometimes they still can be risk averse or they get so stuck on their idea that they're unwilling to see, that maybe it needs to be changed, or I want to use the word pivot, but everybody's so sick of the word pivot, right? So, but something's not working and they may need to change some aspect of it to get it right. We have a great example in our first fund with a company that had one idea that we invested in. The founder, we just thought he was so amazing. And we weren't sure exactly that his idea would be the right one, but he figured out it wasn't the right one. He's iterated a couple times, and it's so great now, like that the last raise they just did was already on paper for us, a 10x for us in our first fund. They got accepted into Y Combinator, and they've got a very much more refined business model now, and they know exactly where they're heading. And we feel really great about that company. So that kind of hustle, that ability to take data and information, make sure, it's making sense for your business. And if it isn't, then doing something different until you find the right thing. That's the kind of founder that we're looking for. Asset light companies. So we don't want to invest in companies that have a lot of hardware. It takes a lot more working capital, and then they have to spend more time raising money or raising more money. Yep. So that's another important, a global market opportunity. So if the company wants to just grow in Edmonton, that's not going to be a good fit for our fund. We need to think about exits, and they need to be at a pretty high multiple for us to make our fund numbers. So we want companies that are thinking big, looking beyond Canada even. And so that's really critical as well.
With these funds then that the first one, and then also the second one, which sounds like it's going to be a larger fund than the first one was, is there a set number or a target number of companies that you want to invest in with those funds? Or, if you have a really big, one that's going to take a lot of capital, you're willing to go a little bit more aggressive and
yeah, no, I mean, all of that has to get modeled out before you start a fund, right? And then if you think about it, in this asset class, typically 50% of the companies you invest in are going to go bust, right? So you start factoring in, and then to make your overall ROI for your investors, how many of them need to hit a 10x? How many do you just want to get your capital back? And how many of them need to be a 25x or even a 50x? Like, you work through that in a financial model. And then that helps you work backwards. Like, okay, so we have this much capital. How much is our check size going to be? How many companies at this stage will we invest in? Do we save money for follow-on investing if we want to go into the next round with, when they do their next round of capital raising? And we will, in this fund, be able to do some follow-on funding for a handful of the companies that we invest in. And then we do have some money set aside to be able to do like really early companies. So they have to have an MVP and, start getting some traction. But, maybe their very, very first raise of capital from people beyond their friends and family. So we'd call that like pre-seed almost, right?
Yeah.
So we're mostly focusing on seed. We'll have a handful of some money to do pre-seed, and then we'll save some money to do follow-on for our seed companies that are moving on. And we want to sort of maintain our position on the capitalization table for that next round.
And how long do you typically want to be invested in a company before you're able to do that exit?
Oh, well, our fund term is 10 years. So we really want to be exited by 10 years.
10 years.
That's the goal. And, some companies may have an opportunity for an earlier exit, and maybe not as a high of a multiple, but because you get the money out earlier, that factors into your ROI calculation. So time is important in the calculation as well, and not just the amount of money or the multiple it exits at.
Yeah. Now, one thing that I'd like to dig a little bit deeper into is the diversity that you were talking about in the founding group, as well as the C-suite and that. So when you look at diversity, are you looking at gender diversity? Are you looking at background, knowledge diversity?
That's a good question.
Race diversity. What is, how do you define diversity?
So we monitor and track visible diversity at the founding level. But when we're looking at the team size and who are the players on the team, we want to see some sector experience, domain expertise, call it, of, depending on what their product offering is, of course. We want to see some diversity at generally the skill set around the table. So, it's great if there's someone who's got a marketing and sales background, for example. There's typically a product or a developer, or a technical background, maybe a business background, right? So, and if they don't have all the diversity that they need today, we want to know that they understand where their weak spots are, and that they, what their plan is to fill those spots and when, right? So sometimes they need to raise the capital, be able to bring in that CFO level person or that financial experience person. And that's why they're raising capital, right? So the key thing is they know where their weak spots are. We shouldn't be the ones telling them. They should already have that self-awareness, so to speak.
And speaking of that, so when they walk into the room, whether it's a Zoom room, I guess, or in person, hopefully in the not too distant future, and have that first initial meeting with you, what do you want them to be presenting to you? How far along does their business plan, their product development need to be? What is the key things that they should be bringing into the meeting?
Well, we don't look at their business plan. Let me be clear on that. But it's great if they've done one for themselves, because I think it's a good exercise in opening your eyes to a lot of the different scenarios, or the different aspects of having a business ready to go. But it depends on how we meet them. So first of all, we get a lot of deal flow from referral from other funds like ours across the country, or other investors that we know, other angel investors that we know that share deal flow. It's a very collaborative community in Western Canada. I can say that for sure. And then, we don't have there's no way for a company to just send in an application on our website by design. We don't want to see that, meet them that way. We generally, my partners and I, are very participative in the ecosystem here. And that's a good opportunity for us to start seeing some of the up and coming companies before they're ready to actually raise capital. So for example, my partner, Shahil Huda, he's one of the mentors in the new 500 Global Accelerator that just started in Edmonton. So that gives them some great exposure to some of the companies. I do some office hours with collabs out of Saskatoon. I get to see some of the companies coming out of that region of Western Canada. We do speed mentoring here at Startup Edmonton, for example. We have contacts in BC. So it's all about getting involved in the community so that you can start to see who are the ones, the up and comers ready to watch, but participating with them, you get chances to hear them. I've been judges in pitch competitions and things like that. So there's a lot of opportunities to meet founders. And, as someone who talks to a lot of companies and founders who are looking to raise capital, my suggestion to them is always make sure that they do their own research on the investors that they are talking to or think they want to talk to make sure that those investors would be a good fit for them. It's got to be a two-way street. And so not all investors are the same. And, there has been a misconception that, I'm a local company, then you're a local investor, you should invest in me. But if you don't fit my investment thesis or you're not at the right stage, I'm not going to invest in you.
Yeah.
And then beyond that, fitting our investment thesis, we also have to believe that we think that you can get this company to a good exit for us. Because at the end of the day, we need our money back, right? That's what we're aiming for as fund managers.
Yeah.
And so that's really important. Those are important things to consider and understand when you're a founder as well.
Yeah. So for fans of the Shark Tank and the Dragon's Den, where we see the interactions that are happening amongst the investor group as well as the founders, the entrepreneurs who are presenting there. One of the things that often happens when the sharks, the investors, have a competing interest in a particular entrepreneur is they talk a lot about their ability to help them beyond just the financing side of things. Is that something that you offer as well then with your organization with Sprout.vc, or is it something where you just focus on the money part of the equation?
No, absolutely not. So our value proposition to the founders is we're willing to do as much or as little mentoring as they need. So because when you're working with earlier stage companies, sometimes they're first time founders, we have some of our portfolio in Fund One. I just came off a meeting with one of our portfolio companies. We have a mentorship meeting with them monthly or bi-monthly, depending on what they need. We have some companies that, like there's one that my partner works on, it's every 2 weeks they have a meeting. And then we have another company that we don't mentor at all because they had great advisors already when we invested in them. So it's what they need, we're willing to help with. We're willing to help make introductions. And when they're ready to raise their next round of capital, again, we're willing to, one, make sure that our limited partners in our fund, the investors, if they are interested in investing in that company directly in the next round of capital raising, we're happy to make those connections for them, make sure that they that they know that those companies are raising in case they do have interest, but also introducing them to other VCs or venture capital firms or investors that may fit into their investment thesis in their next round of capital raising. So ones that are upstream from us.
Yeah. Now, correct me if I'm wrong, but I have the impression that there maybe isn't a lot of women that are in this space in terms of managing and being partners of VC firms. Is that the case? And if so, what does it mean to you to be, one of the women who are really making a difference out there in this space?
It's changing. It's very dynamic. There's some firms that are now very specific female investors only, or female managed only. Like, I don't know if you've heard of the 51 out of Calgary.
Yeah.
That's a full on female founded organization. I think they're investors. You don't just have to be a female to invest. They'll have male investors as well, but they focus investing only in female founded companies. So we're seeing more. I mean, McRock Capital, one of the founding partners there is a female as well. So we're seeing more and more women investors. But I would say that by and large, it's still more male dominated historically, and to today, it's changing. And so I really think it's important that any women that have any kind of aspirations to get involved in this type of space for a career, there's opportunities. There's ways to get involved, and they shouldn't shy away from it because maybe they don't see people that look like them.
Yeah, and I mean, you're very much the face, I believe, of Sprout VC. Is that correct? And for that reason, right?
Yeah, I mean, my partners definitely are very active. I mean, I think one of them just got interviewed for something yesterday, and we're all equally active in the fund. I just like to get out there and make sure that my face is seen so that other young women can see my face and know that they can do this if they want to.
Yeah. Well, really good stuff. Now, if anybody wanted to reach out to you to either learn more about how to pitch their businesses to you, or are looking for some mentorship or some advice, how would they reach out to you then, Kristina?
So our website, Sprout.vc.
Yeah.
And then my email address is Kristina with a K at Sprout.vc. Pretty
Awesome.
simple.
Yeah. Very much so. Well, thank you so much for spending the time today to explain to us a little bit about what your story was, what your background was, how you arrived at where you're at right now, and then also give us those insights with, venture capital companies. There's a lot of businesses that I'm sure that are watching this episode right now who are very interested in taking that next step and looking at VCs to help propel them forward. So, thank you so much for sharing that information.
Well, thank you so much for inviting me. I really had a great time.
Thank you very much. And for those of you who enjoyed this episode, we have the archives over at amplifyyourbusiness.ca. So head over there and check out some of our past episodes, as well as all the future episodes will be there as well. And if you are an entrepreneur who has an interesting story and would like to share it, there is an application form on that page as well. So feel free to enter that. And who knows, you might be featured in an upcoming episode. So until next time, everybody stay safe. And thank you again once more here, Kristina, for sharing your wisdom with us today.